We are at the end of April 2026, and I am doing a weekend show. I wanted to share some thoughts and, frankly, a few concerns with you. Thursday, UBS said that, quote, "we are on the verge of a bubble," unquote. And look, this show is not to be alarmist, okay? It's about knowing when to be extra cautious with our money. And investing is always a risk. We know that. And my aim, is to invest during times of least risk and highest confidence. And right now, there are just a lot of macro unknowns and quantifiable market risks out there. And I want to share them with you. And we can all make informed decisions together. So, look, small cap stocks are selling off right now, and the semiconductor trade is carrying the entire market. These capex recipients are being bought. The broadening trade that had started the beginning of the year has broken support, and there is a concerning market concentration right now in just that one sector, and it is extremely overbought. And I'm going to share all the statistics with you in just a second, but it's overbought. And if it is sold off, I was asking myself the question that I'm not sure what will step in to support the market. Look, interest rates are not getting cut. We've got a trade war and a hot war in the Middle East that are causing inflation, and the stock market is already near or at all-time highs. So I see a lot more questions than fundamental actionable probabilities. So let's analyze the semiconductor sector, since that's the one that is propping up the market right now. So I like to look at the ETF, the Exchange Traded Fund, the SOX, SOX. That's the Philadelphia Semiconductor Index. It's 33 years old. It's been around since 1993. And so it was around during the dot-com crash of 2000, 2001. So allow me to geek out on a little bit of technical analysis, okay? That ETF, the SOX ETF, is up 48% in 4 weeks, almost half. Okay, 48% in 4 weeks. It has a 14-day relative strength index, the RSI, of 86. Okay, 80 is overbought. 86 is absolutely getting to nosebleed levels. It's on a 17-day win streak, which is the longest in its entire history. And it's 42% above its 200-day moving average. And we've talked about that moving average and how that acts as a gravity. It's 42% above the 200-day moving average, over 4 standard deviations away from the 200-day. Look, 3 standard deviations happen less than 1/2 of 1% of the time. A 4 standard deviation move it's a black swan event. And so I'm seeing a rubber band that is absolutely extremely stretched. And like we've talked about before, the principle of mean reversion, reverting to the mean, means that there's a high probability of that rubber band snapping back to the pole of gravity. Let's also talk about the MACD indicator. It's the moving average convergence divergence indicator, and it's a momentum indicator. And it compares the moving averages of any two moving averages of a stock. It reflects strength, direction, and momentum in the price of the stock. It's a little bit of a lagging indicator, so it is backward looking, but the SOX currently has diverged negatively. Okay, the price continues to make new highs, but the momentum is starting to slope downward. And statistics are showing that the institutional money, the hedge funds, the institutional money are selling the semiconductors, but the retail investors, the individual retail investors, have stepped in big time in the last couple of weeks and are buying with a fervor. And so let me also just give a quick reminder of the macro backdrop because this matters incredibly. For 2 months now, we've had the newest in the Gulf Wars, okay, and it is essentially there's nothing leaving the Persian Gulf, which of course accounts for 20% of the world's oil supply being removed from the market. And the stock market itself is, like I said, it's very narrow in scope. So going back a few shows, as the saying goes, oil is the lubricant of commerce. All right. 96% of manufactured goods rely on oil. Plastics, packaging, metal equipment, electronics, clothing, fertilizer, pesticides, basically all construction materials, and of course, transportation of people and goods. Oil is everywhere, whether it's in things or moving things. So again, we covered that a few shows back, and consumer sentiment is below 50, which is a very low measurement. And normally that falls in line with historic recession levels. And the household budgets are being very squeezed right now. We are seeing a tick up in consumer credit defaults. Consumers are not able to pay their credit cards and their bills. And going back 6 months into last year, in 2025, we were expecting lower gas prices and lower interest rates, okay? Both of which are now off the table. So that's just a brief reminder of what's going on in the macro sense. And as you know, I am not into forecasting. I am not into giving stock tips of buying and selling. That's not what I'm doing, okay? It's not about being right or wrong. This is simple risk analysis. Markets are stretched. Technically, we are over-reliant on one sector, semiconductors, and the semiconductors are not trading on fundamentals. Let's take, for example, Intel. Intel is trading at a forward PE, which is 5 times NVIDIA's. 5 times the price to earnings multiple of NVIDIA. And that is the forward price to PE, which has more optimism built into it. So if you think that Intel is 5 times the company that NVIDIA is, go for it. But anyhow, that is, to me, the divergence from the fundamentals. And again, going back to the hot war in the Middle East, we've got 20% of the global oil that's been taken offline. We have a new Fed chairman, Kevin Warsh, who is coming into office, and also a midterm election this year, both of which are historical negatives for stocks. Okay, so again, I'm not being alarmist. I'm simply calling out everything that is in place and measurable. And so I ask myself a simple question. Does my gut tell me that now is a good time to risk new money or not? Okay, to put new money to work or not? And I go back to rule number one. Rule number one, preserve my capital, preserve our capital. And look, in a secular bull market like we had 2 years ago in 2024, where everything is going up and the macro conditions are looking great and there's strong momentum and breadth in the market, then yes, that is absolutely a time to lean in and be a little bit more aggressive overall. But this isn't 2024. So many things are different or the exact opposite. And so by being cautious right now, the worst case scenario is that I'm wrong, okay? And I missed the run. But in that case, I have still adhered to my first principle of preserving my capital. And like I tell my wife, I love it when I'm wrong, because when I'm wrong and the market runs without me, I've missed a little bit of upside, but I have risked no downside. Okay. and just means that I was being a little more cautious. So uh, again, I hope you're having a good weekend, and we'll see what this new week brings. And just wanted to throw out some thoughts about the macro and the market, the narrow breadth in the market right now. And so let's see what happens, and let's all buckle up. Take care, everyone. Bye for now.